Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm speaking with Brian Jacobsen, Chief Economist at Annex Wealth Management. So, Brian, rate expectations have been all over the place this year. We went from something like 6 cuts expected by the market to 1, 0, or even a rate hike. Where do things stand today?
Yeah, I think that today we're still kind of stuck in limbo. We don't really know exactly what the Fed is going to do or when they're going to do it. But I think that's because the Fed itself doesn't know what they're going to do or when they're going to do it. I think a good base case is to think about them probably cutting rates maybe 1 or 2 times. I'm thinking September, they'll have enough evidence that inflation has moderated once again, that they'll be comfortable cutting 25 basis points. And then they'll be able to do another cut in December. Obviously, when we get more inflation data, that will really determine it. But so far, I think a good base case is to think about 2 cuts, but the first one probably starting before the election in September.
And what do you think is going on with inflation? We got those 3 inflation reports, January, February, March. They're a bit higher than expected. Do you think there's a risk that inflation is going to stay, much higher than 2%? And do you think there's a risk that it could accelerate to 4 or 5% like we saw, in 2022 and even 2023?
We have seen a little bit of a rebound with inflation, but here at Annex on our investment committee, when we dig into the data, we don't think we're going to revisit any of those previous peaks. And we don't even think that we're going to revisit, say, 4% for headline inflation. So we do oftentimes see in the historical data that when you have high periods of inflation, you do get a rebound, but it doesn't always revisit the previous peak. We think that the first 3 months of this year, the January, February, and March numbers, were too hot to handle for the Fed. That's the reason why they lost confidence in being able to cut anytime soon. But we do think that the wage growth numbers, really the most recent one, 3.9% year on year, that's pretty consistent with around 2% inflation over the long term. So maybe that big rebound that we saw in the first part of the year isn't going to be repeated as we go through the spring and into the summer months.
So, Brian, as you know, stocks have, taken the uptick that we've seen in bond yields recently in stride. We saw, something like a 5 or 6% correction in the S&P 500 in April, but we're back towards the record highs today. Why has the market been so resilient? And do you expect that strength is going to carry over for the next, 6, 7 months, the rest of the year?
I wouldn't be too surprised if we do see another, say, 5 to 7% pullback after breaching the previous peak for the S&P 500. It seems like there is enough anxiety out there where it doesn't take a lot in terms of news flow or any of the data dumps that we get from the government in order to have a little bit of that rug pulled out from underneath investors. But we don't necessarily think it's going to set us up for a 10% correction or anything worse than that. So as long as you can be patient, we do think that there is some decent upside, more in the small cap and mid cap area in the United States markets. And the reason why maybe the markets, the equity markets specifically, have taken this increase in yields in stride is because of how a lot of those big businesses have termed out their debt. You look at, say, the Russell 2000, so the small cap index, about 41% of those companies are not profitable. Whereas you look at the S&P 500, the vast majority of them are. Also, you look at the debt load, the debt to asset ratio. It's significantly higher in small caps than it is in large caps. And so there isn't as much interest rate sensitivity in the large cap companies as you have in the smaller cap ones. So if we get some yield stability here, which we think that we'll get in a relative sense, we don't think we're going to see the 10-year go back up towards, say, 4.6, 4.75%. If we get that type of stability, that could actually bode well for some of those smaller cap companies that have been left in the dust.
Speaking of yield stability, what's your take on fixed income, Brian? T-bills, they've continued to be the place to be, in 2024. Long bonds, they kind of continue to sell off. How should investors position their fixed income portfolios in the current environment?
Yeah, that's a really tough one because even though those longer term yields are relatively high to what we had in the 2012 to the 2019 period, relative to what you can get in cash, short-term investment grade, it's really, you still have that inverted yield curve. At some point, it does make sense to try to tiptoe into locking in those higher long-term rates. But I don't think investors necessarily need to be in a huge hurry to do that. If the Fed is going to flip the script of what they did in the past, when in the past they used to hike very gradually and then cut aggressively it was really important in the past to really jump out of cash and to lock in those yields. But now the Fed is probably going to be annoyingly patient with those rate cuts. And so if a year from now, we see the Fed funds rate about 100 basis points, so a full percentage point lower than what it is now, that's still a pretty good return on cash. So it is one of those where I think that people should consider how they want to lock in those long-term rates, but they don't necessarily have to be in a hurry to do it. The way that we're positioning things is really thinking about in the short end of the yield curve is to look for more higher yielding instruments. So maybe like short-term high yield, lower quality investment grade. But then if you do want to lock in those long-term yields, the spreads that you get for taking on extra risk is really not all that great. So short-term, we're thinking high yield, whereas for the long-term, those types of bonds, think about more higher quality.
So Brian, we've touched on a lot of the key macro points. You touched on the stock market, the bond market. Are there any other themes you're going to be watching over the next several months before I let you go?
Yeah, I think over the next several months, of course, politics is a spectator sport, but it doesn't necessarily need to dictate anybody's portfolios. And so really the big thing that we're going to be watching is what happens with that inflation data. Will the consumer price index start reversing that upward trend that seemed to be forming at the beginning of the year? And then, of course, we also had the consumer sentiment numbers that basically fell off a cliff. It was horrible in terms of that big move lower with the University of Michigan's consumer sentiment numbers. Now, the key thing for consumers, though, is what do they do, not what do they say. And so if consumer spending begins to slow, that's going to be something to monitor and maybe something that could hasten the day that the Fed actually decides to cut.
Fantastic. Well, we're going to have to leave it there. Brian, it's been a pleasure having you on the show. Thanks so much for your time.
I always enjoy it. Thank you.